Hope everyone is doing well. Let me just check something real quick. So, a few things to discuss here. And one is the daily chart. So, on the daily chart, you can see we're testing the 2023 highs from earlier this year. And overall, this is a trading range day. You can see this entire area right here. We can almost think about it as one large trading range, and we can draw a big box. And this range has support levels. There were bears who were selling and scaling in higher. So they sold up here and they got trapped. The market formed nested wedges, sold off, leg one, pull back, leg two. And now we're testing the upper range of that trading range. You can almost call it a trending trading range environment. We have a trading range, a breakout of the upper portion of the range, and then a sell off back to the top of the prior trading range. We have the 200-day moving average, not far below. It's right here. We broke below it yesterday. We found buyers. And there's a couple of things that I think are important. One, 4,300, which corresponds to the May 1st price level. So we have 4,300. We have the 200-day moving average, which is right here. And we have the August 18th low. I think the reality is the market's going to get back to the August 18th low, and everybody knows it. Now, the question is, are we going to get really close and then get a second leg down, or are we going to reach it? But I think the odds are high that if you're a bull and you bought the August 18th low and you scaled in lower, there's an 80% chance that the market's going to allow you out at break even, and at least a 60% chance that the market is going to get back to the August 18th low. The other thing to think about is the market is 4,300 is about 400 points from the all-time high. So you will have traders buying just because the market's on discount. Weekly chart is also important. Tomorrow is Friday, so the weekly chart is going to decide the close of this current week. And when we look at the weekly chart, earlier in the week, we had a big follow-through bar. And one thing I mentioned was I thought that it would be interesting to see how this bar will close at the end of the week. And in 2 days, we've damaged the bear case quite a bit. Now, this sell-off is strong enough that the odds are we'll get a second leg down. But the problem here is I think it's reasonable for if this week closes as a weak doji, which I think it will, next week could have the potential to be a bull bar in a second leg trap. Sell off, pull back, second leg down, testing this price level. So I do think there's bulls buying down here, scaling in lower, but the sell off's pretty tight. And I think it's better for the bulls probably need some kind of micro double bottom. 5-minute chart. Yesterday we had, let me just refresh this. Yesterday we had a very strong breakout at the end of the day. And because of that, it's reasonable to assume that we would get some kind of measured move today. So measured move from the low of 57 to the high of 64. That ended up being the measured move target today. And you can see right here, if I lock this measured move projection, it projects up to 56 even, and the high of the day was 55.75. We also had a breakout from this rally. We had a rally, you can call it a trading range or a bull channel. We had a bull breakout of the bull channel here, and the market went up to pretty much the same price level. But overall, I thought there's two things. One, because of the daily chart right here, I thought the market was going to go above yesterday's high. And I thought it was reasonable to assume that the market would close above yesterday's high. First bar of the day, a bull bar closing on its high. You can call it a failed breakout of yesterday's bar 75 low. But the problem there is, let me delete this real quick. The problem with buying above bar one in general has a 20% chance it is the high or the low of the day. And because of that, it's a low probability buy above the bar. Now, you will have traders buying above one, taking a chance that bar two and three are big bull bars. If the bulls are really lucky, bar two might look like 60 yesterday, and we might get a strong upside breakout in a second leg rally, two-legged pullback, second leg up. And then bar three is a bear inside bar. It's a weak sell below bar two, probably buyers below. However, you have a big rally on one, big bar on two, probably bulls buying a 50% pullback of one, scaling in lower. And then you can see bar three follow through below two. But I think the bears probably need one more bar. We're testing 4,300, the round number, so probably will act as support. And this breakout was strong enough that there's probably buyers somewhere below. Bar four, inside bar, we rallied. We tested near the close of bar two. So some bulls, they bought a pullback. Some bulls, they bought the close of two. They scaled in lower. Other traders, they bought below two. And when three closed as it did, they scalped out near the high of the bar, betting on a trading range. The other bulls, they bought the close of one, front running the buy. They got trapped on two. They bought more below one. They got out break even right here. Bar five, strong bull breakout, always in long, enough of a surprise that we're probably going to go at least a little bit higher. I think the market is still always in long in the overall context, and that increases the reason or the probability for the market to go and test yesterday's high. However, without follow through, it's still not, it's an okay buy, but better to wait for follow through. And then you see bar six. Six is a bull bar, but it's a smaller bar relative to the close of bar five. Let me get a sip of water. And therefore, it's a warning that the bulls are not as strong as they could be. The bulls did a good job getting follow through after bar five, but why doesn't six look more like five does? Instead, six is a small bar, and that is a warning that something is wrong with the bull case. You will have bulls who bought all the way up, and they'll see this as a disappointing pullback, and therefore they'll look to sell somewhere up here. So a lot of the bulls, I suspect, that are buying the close of five or the close of six may scalp out near the high of the day. But okay, swing buy, taking a chance that we have a double bottom, one and three, that we break to the upside and rally for a measured move. And then you can see bar seven, a big bull bar, but a climactic bar. Three consecutive bull bars, four consecutive bull bars, three closing above their midpoints. Strong enough breakout, probably going to go at least a little bit higher. The problem with bar 7 is 7's a climactic bar. The market rallied and then it paused. Even though the bull bar on 6 is the bull bar on 6 is a small bar, 7's a bigger bar. And that's a sign that, in other words, it doesn't look like this. This is a strong breakout, and this usually leads to follow through on the next day. Big bull bar, another big bar, probably going higher. Here, 5, big bull bar, 6, small bar, 7, bigger bull bar, but not as big as 5. And that's a sign of climactic trading. Same thing to the downside. Here, 74, big bear bar, 75, bigger bear bar, but 75 is really big, and then 76, a small bar. That's a warning that it's a sell climax testing support. And in this case, 75 tested bar 40. Bar 8, out, we broke below 7. So you can see some bulls bought the close of 7, and then they bought more below 7, and they're probably using the pullback to get out near the original entry. Other traders, they saw the rally to 7 as a great opportunity to take profits near the close of yesterday's bar 68. So the bulls, they buy, they scale in lower, they scalp out, probably forming a trading range. It's important to remember that on the open always has a higher probability of having a lot of trading range price action. And whenever you see a rally like 5, 6, and 7, it's important to be aware that there's probably going to be something that disappoints the bulls. Bar 9, inside bar, failed to trigger the buy above 8. 8's a high one buy, but you can see the bulls that bought the close of 7 disappointed on 8. And they used the rally on 9 to exit near the close of bar 7. Are there more buyers or sellers below 9? There's probably buyers below 9, and we're probably going to go higher. But look where we are. We have the high of bar 2, which is the breakout point for the bulls down here. And we have yesterday's high, which is right here. So this is yesterday's high. Right here. And we're right around the midpoint. So the market's deciding, are we going to close the gap above the one high, or are we going to go up here and break above yesterday's high and keep this gap open? If we go straight up, that would increase the chances of a bull trend. If we close the gap below 2, that would lower the probability that the market is going to have a strong bull trend day. And then you can see 10 broke below 9, closing the gap above the 1 high and testing near the 4 high. For the bulls, bulls bought, scaled in lower, betting on a second leg or a trading range. Worst case for the bulls. So the bulls, they'll buy, they'll scale in, betting on sideways, worst case, and best case, second leg up. And then 11, we have a second entry sell and a bear bar. Low probability sell below 11, but the one thing the bears have going for them is a micro channel since the 7 high. Notice the close of bar 7. If you bought the close of 7, your entry price is 19 even. Your entry price is 24 and a quarter. You're disappointed on 8. You try and get out break even on 9. And the market went 2 ticks above your entry price, allowing traders to get out. Here, look right here, 24 even. So the market did not even reach the close of bar 7. And then look over here on bar 11, 20.5. So the point I'm making is the market is not allowing 23.75. The point I'm making is this. If you're a bull and you bought this close, you had one opportunity. If you bought the 7 close, you had one opportunity on bar 9 to exit break even. And 10 trapped bulls further, 11 trapped bulls further, and then 12 went even lower. Since 11, you could argue, is a breakout pullback sell. You could argue there's buyers below 11, bulls buying below 11, therefore it's a bad sell. But the problem is what I stated earlier. The bears are getting a tight channel. And then 12 formed a follow-through bar. It's a weak entry bar for the bears. but it's a bad set. It's a bad buy above the 12 high. And because of that, you have some bulls who bought the 11 low, hoping for a strong reversal on 12, and instead 12 formed another bear bar at the 11 low, and that will cause traders who bought the 11 low exit, and that's why 13 did what it did. The low of 11 is 16 and a quarter, so you buy the low of 11 at 16 and a quarter. You're disappointed on 12, and then look right here, 16.75. So you had one chance on 13 to exit the trade quickly before it sold off. 13 is a bear breakout below a bull flag, the high of bar 8 to the low of bar 10 or 12. Good bar for the bears, but a big tail below the bar. That's a warning that this is more of a trading range and not the start of a strong bear trend. The bears, they need more. So at a minimum, I think the bears need another bar closing on its low. And even then, they probably would still need to do more. And that's why 14 reversed up. For the bulls that bought the 11 low, scaling in lower, they made money. For the bears that sold below 2 and scaled in higher, they made money. So what do you notice about the 13 low? I did not mean to do that. What do you notice about the 13 low right here? Excuse me, what do you notice about the 2 low right here? If you sold the low of 2, your entry price is 5.5, so 43.05 and a half, and the market went to 43.05 and a half. It touched the low of this bar and then reversed up, allowing those traders to avoid a loss. '15, strong bull bar. A little bit of a surprise for the bears. I think most bears would exit above 14. The problem with 14 is it's a wedge. We sold off on 8, we rallied, we sold off on 10, we rallied, and we sold off on 13, testing important support, the too low of today. And because of that, let me get back to where I was. There we go. And because of that, a lot of traders, a lot of bears who sold below either 9 or 11 would exit their shorts above 14. And the bulls, they'll buy betting on a second leg from the 3 low to the 7 high. 15, decent follow through. You can see bulls tried to buy the midpoint of 14. The bears that sold the close of 13, they got trapped on 14 and they tried to exit. Some bears, they sold the close. Some bears, they sell the close of 13. They sell more at the 13 high. They exit around the midpoint of 13, which in turn ends up being around the midpoint of 14. So there's buyers down here. That's why the market went up. 15, strong bull bar, back to always in long. I don't know if we ever went always in short here, but it's always in long on 15, probably by the close. But you can also argue the bulls need one more bar. And then 16, a follow through bar, 3 consecutive bull bars. The bears that sold the 14 high or the 13 high, they got trapped if they didn't get out below 15. Therefore, I suspect there's buyers and the first reversal down will probably fail. We have the target above yesterday's high, and we're probably going to get there. 17, another bull bar, smaller body. So the bodies are getting smaller. That lowers the probability for the bulls, but still the first reversal down probably will fail. 18, a bear bar, but a close at the close of the prior bar. Actually, just kidding. My bar was doing that. 18, another bull bar. And now we have a micro channel since the 13 low and the 18 low increases the probability of the market going at least a little bit higher. And then 19, we have a bear bar. Is 19 a wedge? 81, 7, and then 18 in a double top with 69? It might be. You could argue that this is, in fact, a wedge. My only problem with the argument of the wedge is two things. One, this lower high with 18 and this high with 19, it's close, but I still think we have an important magnet above. We have an important magnet above yesterday's high, and it's a micro channel from the 13 low to the 18 high. The other problem here is the bulls are getting a lot of consecutive strong bull bars. What do you notice about the bears today? The bears have been unable to get consecutive bear bars closing on their lows, and that lowers the probability for the bulls. Bar one, big bull bar. Six, big bull bar. Five, big bull bar. Seven, big bull bar. 14, big bull bar. 15, another bull bar. And then 16, another bull bar. So three bull bars closing near their highs, three bull bars in a row closing near their highs, bear bar closing above the midpoint, bear bars closing near its low, but a tail, small doji, bear bar with the big tail. So you can see the bulls are getting more buying pressure than the bears. And then for the bears that on 19 that sold below, they quickly got trapped on the outside down bar with 20. Is 20 a reasonable buy? It might be, but I think the problem with buying the close of 20 is you're buying right at the 69 high and the high yesterday, and it's possible there's more sellers above than buyers. 21 is a pullback from the 20 bull breakout, but to me, 21 is a bad sell. The bears, they're not getting any decent stop entry sells, and because of that, you have to wonder if the market's forming a small pullback trend. 22 bear bar closing on its low. What about selling below 22? Some traders might, but we're getting a bear bar right below important resistance, yesterday's high. And because of that, it's reasonable to assume that it will trigger and then go up. It's really common for the market to try and trap you out of a good trade. The market's always trying to make traders buy and sell. In other words, it wants traders to churn as many trades as possible. And the only way to do that is to confuse traders, make the probabilities close to 50-50, force traders to buy and buy more lower, sell and sell more higher, and look to scalp out. So 22, it's okay to exit below bars, but I still think I still think probably a minor reversal. So if you do exit below 22, the bulls have to look to buy some again above another bull bar closing on its high, especially if it's a second entry. And then 23, surprise bull bar breaking above all the bars to the left and yesterday's high. Strong enough bull bar, probably by the close and going higher. Probably going to get some kind of measured move on the day. We have a wedge, 1, 2, 3, or 1, 2, 3, and we're breaking out above it. So we may get some measured move of the opening range. 24 follow through, testing yesterday's high, I believe to the tick. So the low of 24 is 31 and 0.75, and the high of yesterday is 31.75. So the bears sell the one high, and they got trapped on 24. They sold the one high, they sold more higher, and they got trapped. 25 strong bull bar, strong enough bar, enough of a surprise, probably going at least a little bit higher. Probably by the close, and bulls, they have targets above. 26, an inside bar, low probability buy, low probability sell below 26, probably buyers below. And then 27, big bull bar. 27, probably exhaustive and not going much higher, but it's still buy the close and buy for any reason, especially if you can use a wide stop. 28, small follow through bar, so a warning that the bulls are not eager to buy up here. And then 29, another bull bar, possible parabolic wedge. We went up on 25, down on 26, up on 27, pause 28, and then up for a third leg on 29. So 40 is a bear bar. I think it's reasonable for traders to exit below that bar. And then, a 30 broke below 29 and then reversed up. What about buying on a stop one tick above 30? You can buy for any reason because the channel's tight and it's by the close. But to me, I think it's becoming a little bit problematic to buy up here. It's really musical chairs. And if you get a bear bar closing on its low or closing at least, 2 or 3 points below the prior bar, I would certainly exit longs. 31 consecutive bear bars, but a tail on 30, tail on 31. Still probably buyers below, but this is probably a warning that the market's not going to go all that much higher. 32, 3 consecutive bear bars. Strong enough, 3 consecutive bear bars in a 4 bar micro channel with 29. Probably sellers above 32 and at least a small second leg down. 33, high one buy. It's a bull bar closing on its high, but it's a 5 bar micro channel. I don't think it's all that great to buy above the bar. I think some traders will if they can use a wide stop and scale in. But I think the concern with buying above 33 is that the bears may get a second leg down after the sell off to 32. And then 34, strong bull bar. Is it buy the close 34? You can buy the close at 34. It trapped the bears who sold above 33, but it's also testing the 29 close. So there will be some profit taking on 34. And therefore, instead of traders buying the close at 34, some traders will wait and see what the follow through looks like. And then you can see 35 is another bear bar. Second entry short for the bears who sold below 35, but a tail below 35 and a fairly tight bull channel and only 3 bars down lowers the probability of traders selling below 35 and increases the probability of buyers below. And then 36, we have a strong rally, strong bull bar, but it's probably exhaustion. We've had several buy climaxes, breakout 23, 24, so reset the count, and then 25, that's one leg, pause. Second leg up to 29, pause, and then a third leg up to 36. And 36 is the best looking bull bar in the rally today. And it's testing targets. We're testing the high from the low of 13, high of 21, and the low of yesterday's 57 to the high of 64. Both of those targets project up here. So as strong as 36 is, I think it's a better sell the closed bar than a buy the closed bar. And if 37 is a big bull bar, you might have bulls exit. You might have bears exit who sold 36 betting on a trap, trapping bulls into buying high. And then 37, a bear bar. So the bears who sold 35 high and higher made money. 37, excuse me, I said the bears. So the bears that sold the 36 close or above 37 and scaled in made money. 36 is also a big bar. So if you're long and you've been long ever since 23 and 24, what are you going to do up here? You look at 36 and you say, wow, what a gift. I was long over here. The market's giving me an extra, what is that? Couple of points. Increases the chances that we're going to go higher. Excuse me, I got distracted. 36 is a big bar. It's giving traders a gift. It's giving them an extra 5 points, 5 or 6 points. So a lot of traders are going to take that opportunity to maximize their profit, betting that the market's going to go sideways because it's gone too far, too fast. 37, strong enough downside move, probably at least a small second leg down. Therefore, probably sellers above 38, the high one buy. Some bulls bought the close at 36, disappointed 37. They'll look to get out break even. And that's why 39 sold off on 40. 39, weak entry bar for the bulls who bought above the high one. So some of the bulls, if they bought above 38, when they look at 39, they will look to sell out of their longs, betting on a second leg down and a test of the moving average. And obviously, we got that on 40. 40, a little bit of a surprise. Is it sell to close? It might be. I think it's reasonable to assume that the market's going to get back to yesterday's high. For the bears, it was reasonable to sell on the daily chart, sell yesterday's high, and look to scale in. So some traders, what they'll do is, and they'll do this on any time frame, not just the daily chart. But what some traders will do is they'll sell yesterday's high and they'll sell more above the prior day's high right here at 54 even. And you can see the market went 1 point above it, sold off. And I believe it reached, obviously, it went below yesterday's high. $40, probably always in short, better to wait for follow through. And then 41, a strong bear bar closing far below the moving average. To me, I think bulls have to be flat at this point. And most bulls, I think, obviously, most bulls got out on 40. They looked at that bar and said the market went down too far too fast and it's probably going to get a second leg down. Therefore, it does not make sense to be long. And then 42, we have a bull bar. It's testing the 33 low. But when you look at 42, is there any reason why you'd buy above 42? No, of course not. 42 has a tail above. And I think the best the bulls can expect is a test of the 40 close. Some bulls bought the 40 close, hoping that 41 was a big bull bar. And instead, when 41 was a big bear bar, a lot of those bulls scaled in and they're trying to get out break even here. Other bulls they bought at a limit order at the moving average for a scalp. They scaled in lower during 41, and they will probably take their profits above 42 or during 42. Outside down 43, testing the 40 close. Low one short, but strong enough 40 and 41. Probably going to get a second leg down, and we'll probably test the 20 high as well as yesterday's high. And then 44, we have a bull bar and a second entry buy. But do you think 43 is the second? Excuse me. Do you think 44 is the second leg down after 41, 40 and 41? Probably not. It's okay to exit shorts above 43, taking it above 44, taking a chance just in case we get a deep pullback. But I think the reality is at least 50-50 chance that we trigger the buy above 44 and we fail and then reverse down. And then 45 is a double top with 43. And because of that, it's a second entry short. So you will have traders who will exit longs above 44. They bought above 44. They were disappointed at 45. They might be quick to scalp out, betting that this is more likely a bear flag that will lead to a second leg down. 46, a bear bar, second entry short, bear bar closing on its low, but testing support, the 41 close, the 43 close. Some bears, they sell below 43, they sell more higher, and they get out break even during 46 or 47. And that's why 48 reversed up. 48 for the bears, it's another pullback testing the 40 close, the bar that became always in short. And because 40, you could argue, made the market always in short, the close of that bar, there will be traders selling a retest of the close of 40. And you can see they did that on 43. They did that during 45, even though it didn't quite get there. And then they did that during 47. So bear bar on 47. Is it always in long? Is it going to be a bull breakout of the past four bars and lead to a measured move and a test of the 38 or 39 low? It might, but we have a tail on bar 47, and we really need to follow through. And you can see 48. As soon as 47 closed, traders hit sell the market on 48, and the market quickly sold off. So you had bulls selling out of longs, and bears selling aggressively. 48, strong enough bar, probably going at least a little bit lower. Bulls who bought the 47 low and more lower are trapped, and that could add to the selling. And then 49, we have another surprise bar, but we're testing yesterday's high, and that's the area where bulls will start buying again and bears will start buying back shorts. What about selling the close of 47? Some traders might, but I think it's a little bit aggressive. You're selling right at the 60-minute moving average over here, right here, and you're selling at yesterday's high. And you know there will be some bulls buying. There will be some bulls buying and bears buying back shorts right here. And that's why 50 looks the way it does. 50, what about buying above, betting on a two-legged pullback, second leg trap? Some traders might, but for me, we have big bear bars 40 and 41, and then more big bear bars 48, 49. I think probably sideways to down is best, but because the bears have two legs down and a lot of bull bars, 42 and then 44 closing on its high, and then 47 being a big bull bar, I suspect not as many traders will be willing to sell down here. And then you can see 51 getting a second leg down after 48 and 49. 51, is that a reasonable sell to close bar? I don't think so. I think there's too much risk of a third leg. It's that it is the start of a third leg down. And we had 48 and 49. It was reasonable to expect a second leg after 48 and 49. And 51 is that second leg. And then 52, surprise, bull bar, double top with 50. Big enough bar, 52. I think it's reasonable for bears to exit shorts above 52. What about buying above 52? Some traders might. I think it's better to wait for more follow through buying though. And then 53, a pause. So bears sold the 51 close. They sold more above 51. And then when they saw 52, 52 obviously let the bears sell more above 51, and they're getting out break even. So let me explain it like this. Traders sell the close, they sell more higher, and then look at the midpoint of the price. They sell this close, they sell more above this bar, and then break even is right around 30 is right around 32.75. 54, a pullback test of the 49 close. Probably sellers above 54 and more sideways, but probably buyers not far below. 55, a bear bar and a second leg down. Possibly the start of a second leg down after 48 and 49, but there's probably buyers not far below, and that's why 55 went outside up. 55 trapping the bears and the bulls. They're hopeful they can get a bull breakout above a bear flag. So we have a bear flag from 50 to 55. They're hopeful we get an upside breakout. We have reasonable targets above. It was reasonable to buy above 44. And because of that, you'll have some bulls who bought above 44. If I can draw this trend line, some bulls who bought above 44, taking a chance that the market would rally all the way up. So they buy above 44, they scale in lower, knowing 60% chance they can avoid a loss. And then 57, we have a strong bull bar. Probably back to always in long on 57. Reasonable buy, okay, swing buy, taking a chance on a couple of legs up. And probably an okay buy the close bar, but target's not far above the 44 high. If I said 54, I meant 44. And then 58, a bull bar testing near the high of 44. So you can see some traders taking profits. Other traders, they bought the 47 close, got trapped on 48, and they will use this rally to sell it longs. And then we got a bear bar on 59. 59, it's a possible second leg trap, rally up to 53, pull back to the 56 low, rally up to the 58 high. Probably buyers below 59, but a bear bar closing on its low, I suspect we might get a small second leg down, and which means the first reversal up will fail. So if 60 is a bull bar, it'll probably be a bad high one, and then you can see instead the high one was above 59, and we sold off. 60 bull bar, but not a great buy above, testing the highs of 58. And then you can see 61 sold off sharply, allowing all these bears who sold to make money and the bears who sold down here to scale in and make money. So that's what I talked about here. We have a low one on, I mentioned it, not right here, but I mentioned it before, kind of like down here on bar two. Traders sell below this bar, 53, and they sell more higher, and then they're allowed to make money. Bears sell below 2, they scale in, sell more higher, and they make money doing that. Give me just 1 second here. Thanks everyone for your for your patience there. Just needed a little. Sometimes around this hour, I get more tired than usual some days. So I had to stand up for a minute just so I could kind of regain my focus. But anyways, going back to over here, we had a second entry short. And the problem with this is whenever you get a second entry short and a pullback, the upside is usually limited because there's sellers not far above. And when you get a bad looking high one like 59, the 58 high to the 59 low is strong enough that you will probably get a second leg down. So let me try and zoom in to better show that. So you can see rally, deep pullback, probably sellers above. And then here, allowing all the traders who sold down here to make money. They sold, they scaled in, all the breakout points closed. Now, what about selling the close of 61? It's an okay sell, betting on lower prices. But my problem with selling the close of 61 is the downside is rather limited. Bulls, we had a leg one, leg two, probably leg three. Bulls, big bull bars here. Bulls making money here. Therefore, as strong as 61 is, I suspect 62 will be disappointing. And again, we're right at that important support level, yesterday's high. 62, a doji, probably sellers above and at least sideways. But just like the bears made money selling and scaling in, you know the odds are the bulls will make money buying and scaling in lower. 63, you can see it triggered the buy above 62. Bears sold. They sold more higher. Bulls bought down here, betting we would get near the 60 low. And then 63 is a tail top, so probably sellers above for at least a small second leg down. 64, bear bar, and then 65. 64 is a low one short, but probably buyers below. It's a wedge. 1, 2, 3. It's also a truncated wedge. And a truncated wedge simply means you have one push down, you have a second push down, and instead, this third push did not go below the second. One thing to remember is patterns are not always going to be textbook patterns. So when something looks like a wedge, computers will see it. They'll see the three push pattern. The market tried to sell off, tried to sell off, tried to sell off. It's probably going to rally. The market likes to move in twos and threes. And the reason for that is because most of the time the market's in a trading range. Things are just good enough for a small second leg down. So for example, one example is this bar right here. 44 is a strong enough bar to at least lead to a small second leg. And that's why 45 and 46 hesitated and then 47 went up. 45 is enough of a move down to at least lead to a small second leg. So if you look at a 1 minute chart, think about what 45 did. 45 sold off and rallied. Well, look what 46 did. 46 sold off below 45 and then the market reversed. So on a 1 minute chart, that's a two-legged pullback after the rally up to bar 44. We had a big sell off here, 41, 40, 40, and 41. The market tried 2 or 3 times to reverse the market, failed, and reversed down. So the market's made up of 2 and 3-legged moves all the time. Probably buyers below 64 because it's a low one late in a move, and context is bad. We're at support. And then 65, a bull bar, second entry buy, but a weak signal bar lowers the probability for the bulls buying above. But weak signal bars are really common in trading ranges. Bad signal bar for a sell below 39, and it led to a decent sell off. Bad buy signal bar above 13, it led to a pretty big sell off or pretty big rally. Bad sell signal bar below 47, but it still went lower. Bad sell signal bar below 60, but it still went lower. And just because 65 is a weak doji does not mean we won't go lower. And you can see 66, a little bit of a surprise bar. Strong enough bar that I suspect the bears who sold above 65 are trapped and they're disappointed. So if you sold above 65 right here, those bears are probably disappointed and will buy back shorts near the 65 high, which means bulls will buy near the 65 high. Probably going to test the 60 low, and we may get all the way up here. We had a rally on a higher time frame, pullback that lasted for several legs. So we have a bull trend line break. Guess what the last thing we need? We need a retest of the highs. 67, another bull bar testing the breakout point 60, but a consecutive bull bar 66, 67. Not quite always in long, but I think it's okay to be long, taking a chance that we rally for a couple of legs. 68, a doji, weak, followed through buying, but a bad sell below 68, so might have more buyers below. And then 69, a surprise bull bar, strong enough bar, probably going to go at least a little bit higher. And then 70, consecutive bull bars. 69, 70, strong enough that will probably get closer to the 39 low, the 38 low. However, look to the left. What happened on 40? You had bulls buying during 40 and they got trapped on the way down. So as strong as 69 and 70 look, it's an area of resistance. Look at 69. 69 is a bull bar closing on its high. Now look at 70. Why does 70 have a tail on the bar? Yes, 70 is a good bull bar, but if 70 was truly a good bull bar, 70 would not have sold off in the final minutes. Look at yesterday. So let's look at this bar. Bar 60, strong bull bar. Look at the open of 61. Do you think you had a lot of time? Let me say it a different way. Do you think bulls at the close of 60 were desperately selling to take profits? No. We know that because on the close of 60, 61 opened and went straight up. And because of that, the market went straight up on 61. You know there's bulls buying. On a 1 minute chart, it's a very strong breakout or tight channel. Today is different. We have this, which is great, but that tail is a warning that the market's probably still going to go a little bit higher, but it may not go much higher. And then we have another bull bar on 71. Still by the close, but getting near support 72, smaller bar. So we have a big bar, bar with the tail, smaller body, smaller bar, smaller body. That's a warning that we're going sideways. This is a buy the close rally. Whenever you get a buy the close rally late in the day, I think it's really, in general, it's a good idea to get out a point or two, or maybe an average bar range below any bar. There's too much risk that you could get a really fast sell off. And if you were watching this bar, you'll remember that that happened. The market started to go down and it went down rather quickly. So if we go to a 1 minute chart, this is what happened on that channel. And this bar on the on the open of that first bear bar, we went straight down, lower and lower, lower and lower. What do you notice about the highs? High, lower high, lower high, lower high, lower high, lower high. So it's a micro channel all the way down. And if you're not careful, you'll buy up here or be long and get trapped on the way down. Whenever you see a bar like 73, you know it's a strong enough surprise. We're going lower, and you could argue it's a reasonable sell to close bar. It's pretty late in the day, so it's pretty aggressive. But the odds are, when you see a bar like that, there's a brief window where it'll at least go a little bit lower, and that's why traders, when they see that bar, they hit sell the market. Now, what about selling this close? At this point, your risk is really big and you're low in the day. You're right at yesterday's high. So you have to ask yourself, is this really due to traders aggressively selling, betting on the market going a lot lower, or is this due to a sell vacuum? What traders have to learn, I think one of the most important things you can learn is all breakouts are vacuum tests of something, support or resistance. And when everybody sees that the market's going to test something, traders step aside. Like right here, traders begin to agree that we're going to test the highs. So the market starts to drift up there. But when it gets close enough to these highs, what happens? It immediately, the magnet gets turned off and the market reverses. Here, everybody decides we're going lower. And because of that, you have traders selling aggressively, but then the bar gets too big and we get too close to support and everybody buys back shorts. And that's why 75 looks the way it did. And then went sideways into the close. For always in, I thought it was always in long, maybe on the close of 5 or 6. But then what do you do up here? I think that it's reasonable to exit below a bear bar like 11. So you reasonable to get out below 11, or if you had a tighter stop, maybe you got stopped out of the trade somewhere down here. But in any regard, traders are getting out. Some traders, they'll get out on the close of 10, betting on 3 consecutive bear bars, probably going at least a little bit lower, maybe sellers above. Bears that are short, I think they get out above 14. And then the bulls, they've got to get long above 14. 15, clearly always in long, buy for any reason. If bears get out below 19 or 20, if they get out below 19, I don't think they buy again above 20. One logical way to trade always in is to use stop entries. So if you get stopped out below 19, you buy again above a bull bar, and you could not buy above 20. Therefore, you're still trapped out. If you get out of longs below 20, a couple ways you can handle it. One, as this bar starts to go up, you can hit buy the market, or you can put a stop above 20. Betting if the market rallies, we may break out above a wedge, or you can just buy the close of 23, betting on higher prices. '24, follow through. '25, more follow through, probably going higher, so always in long. And I think the Bears, where do the Bulls get out? I'd get out a couple of points below 39 or 40. You know that 38 is climactic, so why wait for the market to fall below it? Other traders, they started selling out of longs during 40, and Bears obviously started selling on the close or during 40. Always in short, do Bears get out above 44? I think they can, but if you do get out above 44, you got to look to sell again, either below 48 or as 48 starts to go down. The odds were high that 40 and 41 would get a second leg down. And I thought 44 was low probability that it was a second leg down. You could argue it's not really a great second leg trap. Leg one on 37, pull back leg two to 41. And while 44 is a second leg down from 40 and 41, I don't think it's all that great. Therefore, to me, probably we're probably going sideways. And if the Bulls fail to get a strong reversal or a strong entry bar on 44, I suspect a lot of traders will be pretty quick to exit longs and bears will look to sell again. Some traders, real quick, some traders, rather than selling above the high of 44, they wait for disappointment like 45 or 46, and then they look to start selling because then it would be selling a second leg, and that has higher probability of failing than a first leg. If if bears get out above 44, where do they sell again? Maybe below 46, but I don't think it's that great because of what I said. Bulls probably will get a second leg with 45. I think it's reasonable to sell below 48 or a couple of points below 47. And then still always in short, no reason to get out, no reason to get out. And then 52, I think it's reasonable to get out. You're finding support down here. Yesterday's high, the 60-minute moving average. But if you had a stop above 52 to exit, you didn't get filled. 54, I think it's okay to get out of longs above the bar, still not out. And then you'd be out on this bar. Otherwise, bears get out above 56. Bulls, they can probably buy again above 56, or they can wait for follow through. Follow through 57, still always in long. And what do traders do here? This is pretty tough. Some traders get out below. Other traders, I would get out a couple of points below any bar. And those traders would exit as the market went down. One thing you have to remember is let me keep going with always in, then I'll talk about it. So bulls get out. Do bears sell below 61? They can, but whenever you're in a trading range and you're trading always in, you got to be a lot faster to flip back and forth. So a trading range, it's kind of an elementary way to think about it, but I think it's really important to understand. Let me try and find this drawing thing that I have. So we know that a trend does this. It trends. In a trading range, it goes up, second leg, sometimes a third, sideways, and then it reverses. And then sometimes it's just a second leg down. And then it goes sideways, up, maybe one, maybe two, then three, and then sideways. But anyways, you get the point. It's up, down, it's up and down overall, and it's within a range right here. Trends, they just kind of drift one way. And what you have to remember is right here, this, and it's really hard to draw with this mouse, but it's at least better than nothing. That bear channel right here is a breakout on a higher time frame. So on a 15-minute chart, let's get rid of this pen and let's look at a 15-minute chart really quick. And if I didn't say it, always in. Bulls buy above 66 and they get out a couple of points below. And if you're really aggressive and daring, you sell below 73. This right here is the sell off down to 51. So look at a 15-minute chart. Does that look like a strong enough leg? Does that look like a strong enough leg for a second leg down? Yeah. Now, it's comprised of a series of pushes down. Leg one, pullback, leg two. But that leg one, pullback, leg two is strong enough to be its own leg on a higher time frame. 30-minute chart, leg one, pullback, leg two. And I do this a lot. I'll often put charts side by side, and I do it pretty much every day. I have a workspace down here, and I've got a 5-minute chart and then another chart, and it's of the same market. So a lot of times what I'll do, I'll just play with different time frames. I'll look at a 5 minute and then compare it to a 2 minute, 5 minute, compare it to a 7, a 5 minute, compare it to a 20. And I'm not going to trade that way. But what I'm trying to do is I'm always trying to teach myself and remind myself that patterns are irrelevant, for lack of words. Not everybody's trading a 5 minute, and traders are trading for every conceivable reason. So it's more important to visualize what's going on. And the more that you can visualize that this is one, two, three pushes down, but it's also a tight enough channel that it's one leg. And therefore, 57 and 58 might be a trend line break from this sell off and leading to a second leg down. The more you can understand all of that by looking at the 5 minute, the better off you're going to be. But all that just takes time. So, anyways, when you're trading always in, for me, a general rule of thumb is if the market's always in long, well, general rule of thumb is when I'm trading, I don't want to trade the third leg unless the market is really, really strong. So if I look at the market and I say, yeah, that's leg one, leg two, leg three, it's really dangerous to sell down here because that's a possible third leg. We have a sell climax, another one, and then maybe another one. But you could argue it's 3, 9, and 18. So leg one, two, three, or one pullback two. But these are so strong. And then when you get 26 and 27, we're probably going lower. We have a lot of trending behavior. Let's look over here. Here's a good example. We have a breakout on 22, first leg, second leg up to 27, third leg up to 35. Strong enough by the close, maybe 35, 36. But you know it's leg one, you know it's the third leg up, and it's a bull breakout above a channel right here. So to me, when I see that, I'm generally never willing to scale in. So we have a bad high one above on 36, probably sellers above. If I'm long and I get trapped on 37, I just have to stick my hands up and exit the trade. For limit orders, buyers below two, buyers below one, probably, and then probably buyers below seven, sellers above but are never triggered, buyers below 11, but you need a wide stop. Probably buyers below any of these bars, buyers at the midpoint of five during bar 13, buyers at the low of five, buyers at the four high, buyers at the three high. Yet some traders who would, they'll do things like this. They'll sell the three high right here during bar five. It's not letting me draw the line. For some traders, there we go. They'll sell this high during bar five and they get trapped. So they sell the high, they look at three, and they set a limit order at the three high, betting it's a big enough bar for a trading range. They get filled on four. They get filled on five, excuse me. But then they look at that and say, wait a minute, that's such a strong bar. I don't want to be in this trade anymore. I want out. And so they sell, they scale in, and look what happened. The market goes higher, and it came all the way back to this area and bounced up. The bulls know that, so that's an easy limit order trade. They see that bears are trapped, and because of that, you have a lot of bulls who will buy down here, knowing that the bears will buy back shorts as well. Same thing here. 13 selling off, testing the too low. That's where bears got trapped selling below bars, and you know those bears will exit. Probably buyers below any of these bars. And then what about through here? Do you buy below 27, 28, 29? To me, one of the problems with trading ranges is this right here. The market rallies for an extended period, 23 to 29. You have a very tight channel, and it's a micro channel. In general, micro channels have buyers below. But when the channel's parabolic, like 25, 27, and 29, it increases the risk that the pullback could be deep. So a lot of traders, instead of buying the 29 low, they buy lower. Probably sellers above 33, but with the channel being tight, it's kind of dangerous. They got trapped on 34. And because of that, if you're a bear and you sold the 33 high and you scaled in on 34, what are you going to do on 35? You know you're going to buy back shorts. So there were so many traders. Why did 36 happen? Bears sold above 33. They scale in. So let's just draw that for a second. They sell this high and they sell more, I don't know, somewhere in here. Let's do like this to make it easy. So they sell 45.75 and then they sell more. Let's say they sell at 47.75. That means 46.75 would be their break even price. If you sell the high of 33 and then 2 points higher, obviously 1 point above 33 would be your average entry. The market went to it and then reversed up. But there were so many traders trying to get out of the 33 high, they got trapped. And then traders sold above 37 and scaled in. And other traders, they sold to the close of 36. And then let's see here. I thought 38 had a very high probability of a second leg down. So it was a good sell above. Probably buyers below 42. And what about selling above 45? I don't know. I think that's pretty hard. I think it's better to wait for a second leg up after 44. Therefore, sellers above 45. So for me, I would rather, if I see this, not sell above 44. And then when I see 45, I'd rather look to sell above the bar. And it's even better. We triggered the sell below 45, and then this bar broke above 45. I think that's a better sell. And then that's why 48 went down. And then probably buyers below 50, betting on 2 legs down at support. Buyers below 53, maybe buyers below 59, but a little bit dangerous. You're right at these breakout points and your risk is big. But if you did and you weren't fast enough to get out, which here, if you bought the 59 low, I would get out break even. Whenever I buy an area that might be a little questionable and not the greatest buy, I want out of the trade pretty quick. So if I buy at 39.75 and then the market went to 39.5, so let's say it triggered my buy and it did not go up first, it triggered my buy. If I'm still in the trade and you get a bear bar closing on its low, I'm usually just going to get out around break even pretty quick because it's really not worth the risk. And let's see here, buyers below 63, 64, and that's probably it for limit orders. Buy the close, sell the close. I thought it was buy the close 5 and 6, and maybe buy the close 7, but kind of dangerous. If you did buy the close 7 and then you scaled in below 7, I think it makes a lot of sense. Just get out near break even. Or if you were too slow on 9, 10's kind of tough, but a lot of traders were getting out break even after 10, and that's why we sold off. Buy the close 15, 16, 17, and I thought 19 and 22 were lower probability sells than what they looked. And the reason was I thought it was reasonable to assume that today was going to go above yesterday's high. And this is kind of a classic, you can call it a gotcha moment where you have this blue line, which is yesterday's high. Let's get rid of some lines. So we have this blue line, which is yesterday's high right here. And you look at the market, and the market keeps trying to get above yesterday's high. Try it here. And then you get the second entry sell, and you keep thinking to yourself, maybe there are more sellers. Maybe there's too many sellers up here, and the market's not going to get there. I'm going to sell out of my longs and look to buy lower. And then you get forced to buy above the moving average. It's a classic example of whenever you get a breakout, it's really common for the market to do something to trap you out of a good trade and trap bears into a losing trade. So the bulls, they get trapped out of a good buy below 22. And the bears, they get trapped into a bad sell below 22. And then when 23 and 24 happen, both of those traders are forced to start buying. The bears are forced to buy back shorts and the bulls are forced to buy to go long. But it's always in long, buy for any reason. And then at some point in here, traders get out break even. I thought 36 was more of a sell the close than a buy the close. And then sell the close 40, 41 for a second leg down. Some traders sell, get out, and they scale in, get out break even. Other traders sell and hold, betting on the second leg. If you're holding, I think it's tough to hold above 44, but plenty of traders do it. And then maybe sell the close 48, 49. But if you did, I'd be pretty quick to get out around my first entry. So sell the close at 49, scale in, get out break even. Probably buy the close, maybe buy the close 57, but then you get 58, 59. You've got to be really quick to decide. For me, if if I bought the close at 57 and then I'm disappointed with 58, disappointed 59, I'm gonna be pretty quick to get out, break even at the 57 close. And then I don't think it was quite sell the close on 61, and then probably buy the close maybe on this third bar or the fourth bar, and traders get out a couple of points below 72. And if they're really aggressive, they can sell the close at 73. But I think you got to be really fast to make decisions there. And most traders just should leave, really, most traders should leave all this alone. I think it's okay to buy. In general, a good rule of thumb is at 230, which is bar 72. It's usually better to stop trading. And by the way, this is another little kind of side thing to note. And if you've listened now, you've heard him say it before. And if you have the encyclopedia, I forget what part it is, but it's by the close late in the day, and or by the close at end of day. Anyways, those of you that have the encyclopedia, you know what I'm referencing. And I'll just pull it up real quick. Let me see here. I'm going to answer questions here in a few. So this will be a little bit longer of a end of day review than usual. So I'm going to pull up the encyclopedia for a moment. And it's a really great tool if you have it. And people ask pretty regularly, why can't I buy the encyclopedia and not the course? And the reason is it's not, I know it seems like it'd be more effective, but it's really not. You really need to understand the video course in order to understand the encyclopedia. And here in a few minutes, there's been a question that was asked about what would you do? What would they do for it? They're looking for advice as far as how to start out studying now. So I'm going to spend some time talking about that. But anyways, buy the close. I know it's right here. Go to BTC for buy the close, but too early. And you look right here. Let's see here. It's really, in other words, the whole point behind this is Pacific time, and we're looking at Eastern time. But whenever you get a buy the close rally that begins before bar 72, which is 15:30 or 3:30 Eastern time, whenever you get a buy the close rally that began too early, it usually does not last for the rest of the day. So here, this is pretty early. Buy the close rally, but too early. Buy the close rally here, but began too early. And the sweet spot, as a general rule of thumb, you really want buy the close rallies at the end of the day. You really want them to begin around bar 72. And the reason for that is most buy the close rallies sell the close sell offs. And whenever I say buy the close rally, I also mean sell the close rallies. Most of them only last for 5, 6, maybe 7 bars at best. And that might be really even pushing it. So the reality is you really need it to start around bar 72 to get you anywhere. And the other thing I would say is whenever I'm buying late in the day, or really at any point, I want to be very quick to take profits and protect profits. So if you're long, don't keep your stop down here as the market's going up because, just imagine, you want some coffee or you need to go to the bathroom or who knows what. But if you buy above 66 and you put your stop below 66, and let's say you're up here and you walk away for, 5 minutes, imagine giving all that up. So imagine you put your stop at break even here. You go walk outside or you get a phone call and then you look back at your computer and the market's down here. And that happens enough times where you want to be careful. Okay, let me take a look at some questions. Mike, can you rephrase this for me? What do you mean by one, not the first bar of the day, please? I'm assuming you mean high one. And if you mean high one, comment yes, and I'll talk about that in just a second. One of the first things I want to talk about is there was a question that's been asked at least a couple of times. And what the question is, and here's the question: if you're a beginner and you've never studied Al before or read any of his books and you're really interested in learning, how would you start? Do you have any step-by-step instructions on what the first thing I should do, whether it's books, websites, course, etc.? I'm very eager and excited to learn about trading. Yeah, so the question is, just if we're going to boil it down, where should a beginner start out if you just, let's say it's day 1. You just purchased the video course, you got the books, and you're eager to learn and you're ready to go. I think the first thing that you have to think about is trading has its own terminologies. If you study Al's got his own terminologies with the way he says things. I would start with the video course. And what I would do personally is I would plan on spending for the better part a year to 6 months really studying the video course. Now, the other thing I would say is this: I think it's really important. Everybody wants to, it's easy to become interested in ideas that more or less become hobbies. And I think it's before anyone really starts to study how to trade, I think it's more important that they really sit down with themselves and write down, why do they actually want to learn how to trade? There's an old podcast with Al and Richard who runs the Brooks trading course and basically does everything in the background that we see. There's an old podcast between them where Al mentioned that, there's a lot of ways to learn. There's a lot of ways you can make money other than trading. And if you're in if you're in it, if you're into learning how to trade for the sake of money, you're probably not going to make it. And the reason for that is when you start out in trading, it's really easy to, be interested in studying and you want to, you understand that if I could trade this many contracts, then here's what I'll make in a day or in a year. But then that will not keep you, that's not going to keep you going down the road. And I think what everybody that becomes good at trading has to learn is they have to learn how to truly love reading price action. They have to become interested in reading price action. If you look at LeBron James or Tom Brady in football, they have a certain determination to wanting to be better and better at their craft at whatever it is that they do. And it's more than just money. So that's the first thing. I would learn how to be fascinated with reading a chart. And I would also understand that that's going to take a very long time. So back to the question, what would I do starting out? I would get the video course and I would watch the whole thing and don't worry about taking notes. Just think about the video course. And I would plan on spending 6 months at a minimum doing that. Because the first thing you have to do is you gotta be able to, for example, listen to one of these end of day reviews. You got to be able to listen to it and understand, hey, I understand why Brad says, on the blogs that there's an 80% chance that the market's going to have a trading range open and only a 20% chance the market's going to have a trend from the open. Or, why is the open of the day important? There's all sorts of things. And once you finish the course and you've watched it once, it's important to go back and keep watching it. Trading has a lot of things to learn. And, you can't just, there's no shortcuts to it. You've got to spend a lot of time studying and reviewing every day. So I would find, get an iPad, get your computer, and plan on watching videos every day, as many as you can, and just keep consuming videos. I would also go back and start studying Al in the trading room. So you can get a year's worth of Al for, I think it's like $200. Just pick a year, get all of his videos, and really learn to think like he does. Then after you've done that, you can consider subscribing to the trading room and watching the trading room live But the point is, you've got to learn how to talk the the terminology and understand the terminology before you can apply it. Your next goal, after you've watched the videos and maybe you start reading the books, but I would watch the video course before reading the books. Your goal is to be able to mark up a chart and talk about all the little things. And the beauty behind it is the more you spend looking at charts, the more you'll be able to see and the more you'll be able to understand. And the other thing I would say is this: you're eager to learn, and that's great. But I would really focus on getting a little bit better each day. Trading, it's a little bit of a roller coaster, especially when you start learning and really studying. Everybody wants to figure things out as quick as possible, but that's not reality. Reality is it's going to probably take twice as long as you think it's going to take, but the goal is to continuously learn and think. Remember, if you listen to Al or Al Lee, if you were at the Orlando event last year, and they said this several times, and you can read it in their body language. But I remember there was a comment they were talking, and one thing, it was Al or Al Lee, one of them mentioned, they said that they believe one of the most important traits for a trader is to be able to think and really look at a market and just think about a chart. What is going on with everything that the bulls and bears are doing? So that's what I would start with. But I would definitely get the video course and accept that it's going to take more than just one time watching it. It's going to take many times watching it. And if you accept that, you'll move closer to doing the right thing. Okay, so back to more questions. What do I mean by high one? High one is it's in the video course, number one. So make sure you're watching the video course. We had a sell off, and so we had a breakout to a new high, and we had a pullback, and we have resumption. A high one is the first resumption attempt in a bull trend, or a pullback. We sold off, we tried to resume the trend, it failed and led to a lower sell off. Or, like right here, we have a strong breakout, a pause, that's a high one. A breakout here, 27, pause, that's a high one. We have an inside bar, that's a low one. We sold off on the open, rallied up to bar one, sold off on bar two. By triggering the sell below bar two, that's a low one short. Most low ones and high ones usually have deeper pullbacks. Question: should we watch out? Should we watch every candle during a swing trade? Most of the time, I get out when I see a bad bar, and sometimes the price continues, and I wish I didn't do that. Some other times is a good choice. The more that is something you're just going to face time and time again. And the longer you trade, the more you get used to it. Your ability or tolerance to be able to sit there and do nothing grows. And you just expect the markets, for lack of words, to try and screw you. I try and say that kind of like lightheartedly, but it's like over here. It's what I talked about. The market's going above the high of the day. There's just probably a really, really high probability that you're going to get above the high of the day. And you see bar 22 closing on its low. It's a second entry short. It's a wedge, 1, 2, 3, or a wedge right here. In any regard, you look at 22 and you think, dang, that's a really tough trade to hold below. But I know we're going above the high of the day. So it happens all the time. The market's trying to shake you out of a good trade, a good long, and then the market does that. So that happens regularly. Consecutive big bear bars, you're going lower. It's a breakout with follow through. It's always in short. Odds are second leg down. But then you get this big bull bar on 44 and you think, dang, that's not what I wanted. Maybe this is a trap and we're going to race up all the way up here. But I think the key is really spending time and learning. And the more you learn, the easier it gets. And that's kind of another thing with psychology. Everyone always asks, how do you fix your psychology with trading? I think you really fix it mostly with learning more about how to trade. That is the first key. There's obviously some psychological barriers everyone has to address and deal with, and it's different for everybody. But the first thing you have to do is really understand how to read a chart. You can go to, any, performance coach or therapist, counselor and try and battle your emotions with trading. You can do it all you want, but if you don't understand price action or how to read a chart, you're always going to be fearful. You're always going to be worried. Okay, question. Did we go always in short between bars 8 and 13? Yeah, did we go always in short here? I think it was minor. These kind of deals, what happens is you have traders selling early and they're scalping out on the way down. And the bulls, once they've seen two or three legs down, they look at a big bar like 13 and they say, what a gift. It's a great opportunity to buy at a relatively cheap price. Look at the moving average here. Are we more bullish or bearish? So look at the moving average. We have bars below it, bars above it, bars below it, bars above the moving average, and now we have bars below the moving average. Does that look clearly bullish or clearly bearish? No, it looks like a trading range. You can use the moving average to your advantage. But for me, a good rule of thumb is if it's not clearly always in long, it's probably a leg in a trading range, which means it's going to reverse fairly soon. Okay, how would you count the market's move up? In other words, the 10 o'clock bar here, I'm assuming I'm assuming what they're asking is how would you count the legs? For me, I saw you could argue bar 7 is the first push and then 18 is the second, but you could also argue 81's the first and bar 7 is the second push and then the third push is bar 20. And then you have a double top with 69 and the market broke to the upside. That's one way to count it. But in any regard, we had a trading range, and 23 and 24 was a surprise that changed the market cycle and it shifted the market cycle to breakout mode. We had a breakout above a trading range, and we obviously got a measured move up. Can you post any research on probabilities you frequently mention? I can't find anything in the course or on the site other than you or Al quoting them. You know, That is, you can always do the research yourself. I remember years ago, this would have been probably 2016 or 2015. Someone asked Al in the trading room, they said, Al, how do you know the probabilities are what you say they are? Do you have any advice or research that you can provide? And Al kind of laughed and he said, what Al said was he's been doing this long enough that he knows what the probabilities are and he's back tested it, he's looked at it, and he understands it. For me, one of the things that helped me studying Al was I really just kind of is a little bit of me being naive. And, I was 19 when I really started studying Al. And it was a little bit me being naive, but I just kind of assumed what Al was saying was right. And obviously, I questioned it in the beginning. But the difference for me was I was listening to Al in the trading room, and time again, he would say little things. And then, I don't remember. I wish I remember the exact day, but I often reference this. I'll never forget there was a time at the end of the day, let's say it's bar 66, and the one thing Al mentioned was we're selling off and we started going down, and Al kind of laughed and he said, if this next bar reverses up and closes on its high, be ready for a buy because we could quickly break out to the upside. And he laughed and he said, it's late in the day. I've got to talk in a few. Therefore, I'm missing out on this trade. But if it's a good buy, if it closes on its high, it'll be a good buy. And the next bar closed on its high. And then 2 bars later, it rallied pretty strong. And that wasn't the only time. I remember seeing plenty of other times where Al would say, this is probably going to fail or the market's probably going to find support down here. And he was just too accurate with what he was saying. And it gave me confidence to think, okay, if I could just study and try and learn everything that Al knows and everything that he's teaching, why do I need to validate it? He's clearly explaining things that are right. So it doesn't make any sense for him to make something inaccurate when he's clearly talking about it in an accurate way. So as far as probabilities, have I researched that 20% of the time that bar one is not the high or the low of the day? I haven't, but I've looked at enough days to understand that buying and sell that trading the first bar of the day is low probability. How do I know that? Because I can't tell you the amount of times I've traded the first bar of the day and gotten trapped into a losing trade. I mean, it's all the time. I've done it countless times. And there's other things. I've held all through here and never taken profits and then tried to hold all the way down here and then get squeezed out. I've bought and held all the way up here and instead of getting out during this bar, I was too emotional in the trade and I would get stopped out down here. I've done all those things. So for me, the longer you trade, the more you kind of start to gain experience and your experience gives you a better understanding of the probability. Now, I know that's not what you're really hoping for, and I know that's not the answer you're looking for, but I think that is the reality. And that's what a lot of traders would tell you. Okay, question. Al Brooks says breakouts don't go that far, and the market loves to trap breakout traders after 1 p.m. or 3 p.m. Eastern time. Yeah, 1 p.m. Pacific time, 3 p.m. Eastern time is what this person's referencing. Which time is it? 1 p.m. or 3 p.m.? Oh, okay. I didn't realize that was a question. Yeah, so Al is in Pacific time. So that would be I always get it backwards. I've got a computer that's in Eastern time, but I live in Central time, and then Al's always talking in Pacific time. So it's always confusing me. But 1 p.m. is the 1 p.m. Pacific time is the close of the market in Al's time. So 11 o'clock is Pacific time is 1 o'clock Central time. So let's back up. Let's just talk about what Al says because I know I'm confusing everybody with what I'm saying. There's often a trap at 1 o'clock Central time, 2 o'clock Eastern time. So that's going to be, plenty of instances here. Let's find a better example. Really, let's just do this. So if we go to the encyclopedia, I can pull up traps. There's a trap late in the day. Here's one late in the day. And it's typically, somewhere between about 11 o'clock Pacific time, 1 o'clock Central time, 2 o'clock Eastern time. But, anyways, this is what I was talking about. Late in the day, you get a strong rally and it traps traders into the wrong side of the market. Someone mentioned that they're still waiting for me to make an always in trading video. Yeah, I'll make it here soon. That's a topic that I'm going to discuss more in detail. So stay patient, but I will make one. Question. Is it better to trade a 5 minute chart or put limit orders on a 1 hour for swing trades, buying pullbacks on 5 minutes, which is a tail on the 1 hour chart of the previous bar? Yeah. So what you're asking, a lot of traders, when they are trading higher time frames, they'll dial down on a smaller time frame. So if they're looking for a setup in a stock, a lot of times they might look at a weekly chart, look for a good setup, then go to a daily chart to enter. Or, you can, if you understand that the daily chart's at an important support level, you can go to a 60-minute chart. Or if you're looking at a 60-minute chart and you're thinking to yourself, let's just look over here. Okay. So right here, we know we have a sell climax, another sell climax far from the moving average. You're looking at the 27th and you're thinking, yeah, this is probably going to fail fairly soon. I should look to buy a reversal up. Well, if you buy up here, you're buying at 4,300, and that is yesterday, 927. So 4,300 is up here. But if you look at a 5-minute chart, there's a decent buy signal right here. So you would have gotten in 15 points at a better price, and traders do it all the time. Okay, so I've got time for one more question. Is bar 36 an exhaustion bar? Also a wedge, therefore a good sell. Bar 36 is an exhaustion bar. You can call it a wedge, 1, 2, 3. It's a reasonable sell, but a lot of times if you wait for a stop entry to sell or wait for a strong breakout, you don't really miss that much. So for me, I sold the close at 36 and I scalped out during the bar. And part of the reason for that was I thought there was a reasonable chance we would test the close of 36 because I figured if bulls bought the close of 36 and scaled in, they might be able to get out break even at the 36 close. And then I sold a pullback. All right, so this is all the time I have. But thanks everybody for watching, and I will talk to everybody soon. Tomorrow's end of day review will be in the trading room. So if you're a member or a subscriber, you will have access to the recording and can watch that in the webinar tomorrow. All right, hope everyone has a good rest of their day.